Let's shed some light on the biggest financial cover-ups in history. South Sea Bubble. In the early 1700s, Britain had a problem: too much government debt. So they came up with a clever solution. They created the South Sea Company and gave it a monopoly on trade with South America. It sounds impressive, but there was one issue. There was almost no trade. Because most of the territory was controlled by Spain, ships barely moved and profits barely existed. Britain was pretending to be a neighbor to Spain that can just walk into their house to grab some coffee. That lack of profit wasn't emphasized. Instead, the company promised future riches, untapped markets with massive growth and unlimited potential. So, shares exploded. Politicians promoted it. Aristocrats bought in. Even Isaac Newton joined in on the fray. But behind the scenes, insiders were quietly selling. And when reality finally showed up, that there was no real business, the price collapsed. Fortunes disappeared, and it was framed as unexpected market panic, not mass deception. Mississippi Company. France saw what Britain did and thought, yeah, let's try that. So they created the Mississippi Company. Same idea: trade monopoly, huge promises, no real profits. It was focused on colonial trade, tobacco, and even the Royal Mint. The company was tied directly to the French government, which made people feel safe. If the state supports it, how bad can it be? Shares were promoted aggressively. Prices skyrocketed. People borrowed money to invest. Paper millionaires everywhere. And to keep things going, the government quietly printed money to support the scheme, to keep prices up and to avoid panic. Until they couldn't. When inflation hit, people couldn't withdraw their money. Confidence cracked, and everything collapsed. It was blamed on speculation, not on the fact that the entire system was artificial. Railway Mania. Let's go back to the UK real quick. In the 1800s, railroads were the internet of their time. New technology with real impact and massive potential. So, investors rushed in. Railroad companies formed overnight. Projects were announced before funding existed. Routes were planned through empty land. And the numbers were creative. Costs were understated. Revenue was exaggerated. Timelines were fictional. But none of it mattered. As long as shares went up, nobody asked questions. Banks financed projects that made no sense. Politicians backed routes that benefited friends, and promoters cashed out early. So when profits failed to appear, the bubble burst. Thousands of miles of useless track and millions lost. Classic systemic misrepresentation represented as over-enthusiasm. Standard Oil. Standard Oil became America's oil tyrant. They never collapsed. They took over. And they didn't do it by being louder than everyone else. They did it by quietly controlling everything around them. On paper, Standard Oil looked like just another oil company. In reality, it controlled the railroads that moved oil, the refineries that processed it, and the pricing that decided who survived. Basically, anything related to oil in the US had a stamp of Standard Oil on it. Through secret deals, hidden ownership, and private discounts, they made sure competitors always paid more. If you weren't part of the system, you couldn't compete. Small companies failed because the game was rigged. To the public, it looked like efficiency. To politicians, it looked like success. But to rivals, it looked impossible. Before you knew it, Standard Oil was everywhere. Your water bottle probably had their fingerprints on it too. Eventually, the Supreme Court stepped in. They ruled it was an illegal monopoly and forced it to break apart, splitting it into numerous smaller, competing firms. The cover-up was about hiding control. Panama Canal Scandal. In the late 1800s, France tried to build the Panama Canal, a massive engineering project run by a French company. It was supposed to be a triumph. Instead, it became a financial disaster. Costs exploded. Over 20,000 workers died. Diseases spread, and timelines failed. But investors were told everything was fine to hide the facts. Reports were adjusted. Losses were hidden. Risks were minimized. And members of the French Parliament were bribed to keep it all hidden. Banks kept selling shares. Politicians stayed quiet. Media softened coverage. But you're probably asking yourself, why would they cover up such a failure? Because too many powerful people were involved. So when the truth finally came out, not only did the company responsible for the project collapse, but so did the French government. Hundreds of thousands of small investors were wiped out. And instead of accountability, many people looked for someone to blame, which fueled waves of anti-Semitic scapegoating across France, all because a financial failure was hidden for too long. Wall Street crash of 1929. In the late 1920s, the stock market was unstoppable. Everyone was investing. Taxi drivers, shop workers, students, retirees, your school's pet hamster. If you weren't in the market, you felt stupid. But behind the scenes, something else was happening. Large investors and executives were quietly selling, not loudly, not publicly, slowly. While newspapers talked about permanent prosperity, insiders were moving to cash. They saw the debt, the speculation, the leverage, and they got out first. When the crash hit, regular investors were still holding. It was framed as sudden panic, not as a quiet exit by those who knew. And that collapse helped trigger the Great Depression, a decade-long crisis that shattered trust in the U.S. banking system. Savings and loan crisis. You know the 2008 financial crisis. Well, this was that before it. In the 1980s, America had thousands of small banks called savings and loan institutions. Their job was simple: take deposits, give out home loans, stay boring. And it worked for decades, until inflation hit. Interest rates went up, and suddenly, these banks were paying more to depositors than they were earning from mortgages, which means they were losing money every day. So instead of admitting the problem, rules were loosened by Congress. Banks were allowed to take more risks. Real estate, commercial projects, speculative deals. Basically, gambling with savings. Losses were hidden. Bad loans were rolled over. Numbers were adjusted. Regulators looked away. Why? Because closing hundreds of banks would cause panic. So they delayed, and delayed, and delayed. Meanwhile, executives paid themselves bonuses. Some institutions were already bankrupt on paper, but still operating. When the truth finally came out, over 1,000 banks had failed. Taxpayers paid the bill, more than $100 billion. It was framed as bad management, not a decade of pretending everything was fine. Enron. Enron was once America's smartest energy company. At least, that's what everyone was told. It was praised for innovation, for creativity, for reinventing energy. But behind the curtain, most of the profits didn't exist. Debt was hidden in shell companies, and losses were moved off the books. It basically became a global game of Where's Waldo, but for Enron's debt. And as long as the stock price stayed high, nobody pushed too hard. Analysts who questioned it were mocked. Employees were encouraged to buy shares. Executives quietly sold. When the structure collapsed, there was nothing underneath, just paper. Kenneth Lay, the owner, died before he could be sentenced. Jeffrey Skilling, one of the executives, was convicted and sent to prison for fraud, after billions were already gone. Worldcom. Worldcom was the second-largest telecommunications giant in the US. They didn't invent complicated structures or new tech, but something very simple. They lied. Expenses were labeled as investments. Losses were reclassified as assets. Numbers were adjusted manually, with keystrokes. Billions of dollars appeared out of nowhere. Banks ignored it, and auditors missed it, all so investors would believe it. The company was apparently too important to fail, so anything suspicious was thrown under the rug to make it look like the stock price was still going strong, because questioning it meant rocking the boat. When it was finally exposed, it became the largest accounting fraud in American history at the time. More than $11 billion gone. Lehman Brothers. Worldcom was the second-largest con in U.S. history. Lehman was the first. Lehman Brothers was the fourth-largest investment bank in America, anything you can think of. Equities, trading, derivatives, sales. If it made money, they did it, and they backed it up. Strong balance sheet, healthy liquidity, low risk. Quite the powerhouse, at least on paper. In reality, they were temporarily hiding debt. Right before reporting periods, Lehman would move billions off its books. They made a technically legal yet misleading move called Repo 105. Here's how it worked. Lehman transferred securities, which was just debt, to third-party companies with an agreement to repurchase them in a few days. Labeled the whole thing as a sale, and boom, debt hidden. Investors saw clean numbers. Rating agencies stayed calm. Executives kept those juicy bonuses. But underneath, Lehman had less real cash than its competitors. So when the mask slipped, everything collapsed in a matter of weeks. Lehman's fall didn't just end a company. It helped ignite the 2008 financial crisis. Wirecard. Wirecard was supposed to be Germany's tech champion, a modern payments company, global reach with fast growth. The company focused on payment transactions and risk management while also issuing physical and virtual cards. Basically, early digital payments, before fintech went mainstream. One small problem: the cash didn't exist. Billions of euros were supposedly sitting in Asian bank accounts, yet no one could verify them. Auditors kept playing pretend, and politicians kept defending Wirecard. Journalists who questioned it were sued for defamation. Short sellers were investigated, but not the company itself. When investigators finally checked the accounts and realized the money was gone, it became a hunt for the heads of the operation. CEO Markus Braun subsequently resigned and was later arrested. COO Jan Marsalek disappeared and remains a fugitive wanted by the German police. Toshiba. Toshiba was a Japanese multinational giant known for its electronics and infrastructure products, energy systems, industrial solutions, IT, semiconductors, and data storage. Toshiba dipped its toes in a lot of places. Profits were reliable. Leadership was strong. The books looked spotless. But behind the scenes, executives were pressuring managers to fix the numbers. They set impossible targets that employees couldn't realistically reach. So they were met on paper. Every loss was delayed. Costs were hidden. And revenue was pulled forward before it was even made. Quarter after quarter. No one wanted to be the person who said, "This doesn't work." So everyone adjusted. When the truth came out in 2015, they admitted to inflating profits by a whopping $1.6 billion, which was later found to be even higher. The major fraud led to the resignation of the CEO and half the company's board. But unlike most of the company's scandals we've talked about so far, Toshiba still exists. Not as a conglomerate that it once was, but in 2023, it was taken private and bought by Japan's industrial partners. a fraction of its once large empire. In fact, the next few cover-ups also have fragments of their former glory today. Parmalat. Parmalat was Europe's dairy giant based in Italy. Milk, yogurt, cheese, all that yummy stuff. It looked boring, which made it trustworthy. But in reality, it's been bankrupt for years. Executives created fake bank statements, fake accounts, and fake assets. They claimed billions in cash that didn't exist. In 2003, the truth came out. There was a $20 billion hole in the books, created through fabricated documents and offshore shell companies in the Cayman Islands. And it started with one phone call. Here's how that went down. Bank of America, how can I help? What? Parmalat is forging the bank statements it's sending us? This is absurd. Thank you for notifying us. Is this true? Maybe. You'll be hearing from our lawyers. December 23, 2003. The lawyers joined the party. December 24th. The company is no more. It now only exists as a subsidiary of the French group Lactalis. Luckin Coffee. This one actually has a surprisingly successful recovery. Luckin was China's answer to Starbucks. Fast expansion, cheap prices, thousands of locations. It grew at absurd speed, possibly too absurd. And that's why investors loved it. The story was perfect. Except that it wasn't real, of course. In 2019, they fabricated over $300 million in sales to keep up with expectations, all successfully done by employees who were ordered to fake transactions. It was all done for one simple reason: to meet growth targets and keep the stock price up, to look unstoppable. Yet, in hoping to keep the stock price up, once this was all revealed, the stock price plummeted, and Luckin Coffee was removed from NASDAQ in June 2020. The CEO and COO at the time were tossed out. The SEC came to a settlement with Luckin in worth of $180 million for defrauding investors. But they were able to bounce back in 2022. It rebuilt itself around small kiosks, mobile orders, and delivery. A lean, low-cost model. Volkswagen Emissions. Everyone knows Volkswagen. Efficient, responsible, future-focused, especially with diesel. But when the spotlight is on you that brightly, it's hard to hide something. Their cars were advertised as low-emission and environmentally friendly. The only problem with that is that they weren't. Illegal software was installed in roughly 11 million cars worldwide to cheat emission tests. During inspections, cars behaved cleanly. On the road, they polluted massively. Executives knew, engineers knew, but anyone outside of that didn't. The cover-up was exposed by independent researchers working with the International Council on Clean Transportation. They conducted on-road tests and found significant differences between their own results and what Volkswagen was bragging about. The numbers didn't match. Not even close. When the cover was blown, apart from the reputation damage, Volkswagen pleaded guilty to criminal felony counts in the US, paid $35 billion in penalties, and several executives and engineers were charged, with some receiving jail time too. Subprime mortgages. These mortgages were the ignition of the 2008 financial crisis. Back then, banks wanted more loans. Not better loans. More loans. So standards dropped. Just like people's standards after they drink. People with unstable incomes got mortgages. People with no savings got mortgages. People with no chance of repayment got mortgages. But that risk wasn't highlighted. That would have ruined the sales pitch. Loans were bundled together, mixed, and repackaged, then sold as safe. Bad borrowers were hidden inside good ones. It's like buying a sack of apples without knowing half of them are rotten. On paper, everything looked balanced. In reality, the system was fragile. When housing prices stopped rising, it cracked, and the damage spread everywhere, almost overnight. Credit rating agencies. This goes with the previous topic, basically fuel to the fire. Before 2008, financial products needed approval. They needed ratings. AAA meant safe. Anything below that meant risky. The agencies providing these ratings were paid by the same banks selling the products, which is already a problem. Banks would bring complicated securities to them and ask, "What rating can we get?" If the answer wasn't good enough, they'd go somewhere else. So standards softened so that more money could fly in. You could bring them a bank that was on fire, with no security, surrounded by crocodiles, and they'd look at it and go, "This looks great," just to get the cash. Risk was minimized. Warnings were buried. Complexity was rewarded. Toxic products were labeled safe, and everyone pretended not to notice, until it was too late. LIBOR Manipulation. LIBOR, or London Interbank Offered Rate, was supposed to be simple. It set interest rates for trillions of dollars in loans, mortgages, student loans, corporate debt. If it involved borrowing, LIBOR was there. Every day, banks reported what it cost them to borrow. No verification, no real oversight, just trust. Some banks lied, go figure. They adjusted numbers to benefit their trades, to look healthier, to avoid scrutiny. Small changes, massive impact. Now, this on its own is bad enough, but the problem was LIBOR also affected U.S. markets, therefore being forced to follow American laws. And we all know how the U.S. is about their money. After the scandal in 2012, everything went up in flames, but the fire didn't stop burning until June 30th, 2023, replaced with new rates that didn't rely on "just trust us." Swiss bank secrecy. For decades, Switzerland was the world's vault. If you wanted money hidden, you sent it there. No questions, no disclosures, no cooperation. Dictators used it. Criminals used it. Tax evaders used it. And banks knew that, so they abused it. Because secrecy was tradition. Privacy was policy. When governments complained, it was quietly behind closed doors. Banks apologized politely to make it look like they'd do something about it, but nothing ever changed. Until the 2022 Swiss Secrets investigation on one of Switzerland's biggest banks, Credit Suisse, showed they held accounts for drug lords, criminals, and traffickers, managing around $125 billion for them. The leaks forced transparency, and it's an ongoing issue till this day. Offshore Tax Havens. This one isn't a secret anymore, but it used to be. Huge corporations often pay tiny amounts in tax, not by accident, but by design. Profits are shifted between countries. Subsidiaries are created in low tax zones, and paper headquarters appear on islands. Legally, governments know about it, accountants designed it, and auditors approved it. It's framed as tax efficiency, not avoidance. But through multiple leaks, with the main ones happening in 2016, 2017, and 2021, the global elite and politicians were exposed for using shell companies to hide assets, evade taxes, and launder money, all while normal people paid full price. Perfectly legal, perfectly broken. Bretton Woods breakdown. After World War II, the global financial system was built on gold, so the Bretton Woods system stepped in. Currencies were tied to the dollar. The dollar was tied to gold, a perfect link. It was supposed to create stability, but by the 1960s, it stopped working. The US was spending heavily, printing more dollars than gold could back. They were unable to maintain the fixed $35 per ounce of gold state, and it kept rising. There just wasn't enough gold to back it anymore. And other countries noticed this. They started asking for gold instead of dollars. So officials delayed, downplayed the whole thing, and reassured everyone it's all good. Publicly, everything was under control. Privately, it wasn't. In 1971, President Nixon officially ended the gold standard, and the link between the dollar and gold was broken, leading to this system becoming a thing of the past. Greek deficit masking. Before joining the EU, Greece had to meet strict rules. Low debt, low deficits, stable finances. Basically, they had to look like an A+ star student. They didn't. So the numbers were adjusted. With help from major banks, mainly Goldman Sachs, Greece used cross-currency swaps to convert debt denominated in dollars and yen into euros at imaginary exchange rates. Due to this, on paper, Greece qualified. In reality, it didn't. For years, the problem grew. When the truth surfaced, the crisis was massive. The deception became public in late 2009 when a new government admitted the deficit was actually 12.5% of GDP, more than 4 times the previous estimate of 3%. And behind it all, over 280 billion euros in debt. That couldn't be hidden anymore. Japan's zombie banks. After Japan's asset bubble burst in the 1990s, banks were in trouble. Huge bad loans with falling asset values. But instead of admitting defeat, the government kept funding these banks so that they could lend money to failing companies. A giant game of pretend. These were called zombie banks. They weren't dead. They weren't healthy. Just casually existing. For over a decade. The existence of these banks didn't cause any massive crash or scandals, but it did stagnate Japan's economic growth for almost 2 decades. But at least there's a happy ending. The issue was resolved with the creation of the Resolution and Collection Corporation to buy bad loans and create stricter regulatory actions. Argentina's economic data control. Argentina has a long history of financial instability, inflation, debt, currency crises, and in the 2000s, inflation started rising again. But this time, the government had a brilliant idea: document manipulation. This mainly happened during the administration of Cristina Fernández de Kirchner from 2007 to 2015. The government underreported its inflation rates. For example, if the government said it was up 10%, in reality, it was up 27 to 28%. Anyone who went against the official numbers, mainly private economists, were threatened with jail time and fines exceeding $120,000. Upon taking office in 2015, President Mauricio Macri suspended official data publication to overhaul the National Institute in charge of statistical management. The problem of high inflation in the country exists to this day, but, at least it's public now. China's shadow banking system. China's official banking system is tightly controlled. In 1983, the People's Bank of China became the central bank of the country. But outside of it, another system grew. Shadow banking emerged in China in the late 90s, but took major effect after the 2008 financial crisis. In a nutshell, the point of it existing was straightforward. The traditional banking system couldn't meet the spike in demand for funding because of tight regulations on lending. So they did it themselves. But don't confuse shadow banking for actual banks. Most were actually wealth management products, or WMPs. High-yield investments, high risk, low transparency. Trillions of dollars moved through channels that weren't transparent. All processes of the transactions were hidden and masked. Local governments depended on it, developers relied on it, and investors trusted it. On its own, it was kinda unstoppable. But the housing crisis in the country caused many massive shadow banks to collapse during 2023 and 2024. Think of it like the whole system crumbling under its own weight. But even through all of these cover-ups, there is one that we are living through as we speak. And I think you all will find out soon if you haven't already.